So column B is semi-annual interest rate. We calculate like this. Column C, interest expense, which is carrying value multiplied by this market interest rate 4%. So premium is calculated as interest payment minus interest expense. So this 336 will be less from, let me just write it down, minus 336. So this 10764 came from 10, let me write it down here, 104 minus 336, answer would be 103764, right? So you see premium approaches to zero. We retire our premium to zero, and this is less, so that this amount will become to face value at the end of the maturity. In case of the discount is added here so that it becomes to the equal to the face value. Okay, so now let's talk about the entries like that. Let's talk about the illustration. So what would be the interest expense recorded on first 6 months, which is July 1st? The expense going to be what we have, because we will pay 4500, right? So 4500 we will pay that. How we going to retire that one? So we say that interest expense, which is 4164, premium, which is 336, to cash, which is 4500. If you see, the entry is balanced, right? Debit is equal to credit, right? So the graphical representation is that interest payments are same, but interest expense start decreasing, and the bond is like that. We receive more money, and eventually it has to come down to the bond value must be equal to the face value at the end of maturity. So question is, why there is 10 here? These are not years, these are periods. So in 1 year there are 2 periods, right? So that's why if you ask me the year, so in year 2 periods, write this, right? Okay, so we successfully ended our long-term liability, and we talk about how we're gonna account for bonds, long-term debt. There are other kind of debts as well, so the objective is not to discuss here extensively. So just up to the bonds payable and the treatment of premium and discount, and if bond is issued at par, that is enough for you at this time. So let's talk about the equity. Equity is the last part of our balance sheet, and let's talk about it. So explain the feature of corporate. You already know in your introduction to business. I'll just go through here quickly. So advantages of corporation is that you can raise more capital because everybody can participate, because there are limitation on partnership there, and also there is a limitation of sole proprietorship as well. So plus the advantage is that the owners can die but business don't die. Going concern, continuous life, right? And here ease of transferring ownership. You can sell your share and the other person become the owner of the part of the ownership of the company. The shares can be sold. Plus the biggest advantage is the limited liability. So you will lose up to the amount you invested by purchasing the share. That's it. The disadvantage is that this is the structure of companies that runs by management and owned by shareholder, right? So there is a clear separation. We call that agency. Management are the agents of the ownership of the owners, okay? And they're going to be double taxation, because in the eyes of law, corporate is an entity, a person, When corporate earns money, it is taxed. When corporate distribute money to the shareholders, their income is also taxed. So we call this double taxation. And also government regulation is different for individual and for company as well. That is also one big disadvantage.